With interest rates starting to fall, is there an opportunity to use the equity in your home for investment purposes and accelerate your wealth creation? It's something we're certainly evaluating with several of our clients, so I thought I'd share with you today our current thinking. Thanks for joining us on another Financial Autonomy episode. My name's Paul Benson, financial planner and practice principal at Guidance Financial Services. Let's dive into this week's edition. Is now the time to use the equity in your home to build wealth? In thinking through this question, there are four key considerations. The first two have greater significance than the second two, but all have relevance. Okay, so number one is risk appetite. Borrowing to invest is a mechanism for increasing risk across your balance sheet. Using the equity in your home to invest is something only someone with a high risk tolerance should contemplate. The investment you undertake has an unknown outcome. We expect it to increase in value over a 7 to 10 year period, but there are no guarantees. What is guaranteed, though, is that you'll have to pay the bank back its money, along with interest over the journey. There is the potential that you will have to exit the investment at a point in time where the value of the investment is less than what you borrowed, in which case you'll have to come up with the shortfall. It's unpleasant to contemplate, but it would be imprudent not to consider what you would do in such a circumstance. It's far from essential to pursue a gearing strategy. Be honest with yourself, and if the risk doesn't sit well with you, consider accumulating wealth via surplus cash flow instead, a perfectly viable and successful approach. Number two is the cost of money. The cost of money has a huge impact on the likely success of a geared investment portfolio. We know that on average, a portfolio exposed to the ASX 200 index is likely to produce a return of around 8% a year. The US index perhaps closer to 10%. So as a starting point, if we're to entertain borrowing to invest, we really want the interest rate to be below those two expected earnings rates. Now, there is nuance here. The interest on the debt is tax deductible. The Australian shares might throw off some franking credits. And capital gains tax only applies to half the growth, provided you've held the assets for more than a year. Nonetheless, when deciding whether to pursue a gearing strategy, it is important to consider the interest rate that you'll have to pay. This can be where using the equity in your home is attractive in funding a gearing strategy because the interest rate is lower than would be the case for a pure investment loan. Right now, we seem to be in a falling interest rate cycle, and that should be helpful to making a gearing strategy stack up. But bear in mind that this type of strategy is usually for a 7 to 10 year time frame. There may be several interest rate cycles across that period, quite likely including some rising cycles as well. Usually, rates are high when the economy is booming and the central bank is trying to slow things down. So typically, were interest rates to rise to the point where the strategy no longer stacked up, it's likely you could exit successfully because in a booming environment, probably the stock market's up too. In reverse, in economically tough times, interest rates are usually cut, so there might be improved affordability during environments where your investments could be struggling. That's what you'd hope, but of course, nothing's guaranteed. Okay, item number 3, security of income. Using the equity in your home to establish an investment portfolio requires that repayments are made on the loan that you established. Now, whilst investments may produce some income, the amount and frequency won't align very well with your loan repayment obligations. To make this strategy work, you need to have the surplus cash flow available to cover those loan repayments, irrespective of what the investment portfolio produces. Your investment portfolio would ideally have a strong bias towards growth rather than income, and you would reinvest the income that it generates, if at all possible, to help compound growth and enhance the likelihood that the portfolio value will exceed the value of the debt and thus reduce your risk. All this points to the importance of having security of income. A particularly bad outcome for a geared investment strategy would be a situation where there's an economic slowdown and simultaneously you're made redundant at the same time that the stock market has fallen. A forced liquidation of the portfolio at this point in time, because you could no longer afford to service the debt, would be highly likely to produce a poor outcome for you. Given this potential, it's important that if you're contemplating using the equity in your home to invest, you have the confidence that your income is secure across the economic cycle. You need to be able to hold this investment through the inevitable challenging times. Over the investment time frame, you should expect to experience 2 to 3 years where the value of the portfolio declines. You need to be able to weather these periods. Okay, and the fourth element is investment time frame. The final key consideration when contemplating using the equity in your home to invest is your investment time frame. As I've mentioned a couple of times now, I'd not recommend this strategy for someone unless they've got at least a 7-year time frame and ideally a 10-year time frame. We know that investment markets go down roughly 1 in every 4 years, but we have no idea when those negative periods will occur. It's also totally possible that you could have 2 negative years in a row if you were particularly unlucky. As mentioned earlier, irrespective of what the investment does, the bank will want its money back. To manage this risk, it's essential that the investment has a long time frame so that the inevitable down years can be comfortably offset by the far more frequent positive years. Borrowing to invest can certainly be a great way to accelerate your wealth creation, and using the equity in your home to do it can work particularly well as the borrowing costs are normally low relative to your alternatives. But it's not a strategy for everyone, and it's not a strategy that is suitable all the time. One final thing for you to consider is your goals. Goals come at the start of any discussion about investment strategies. Borrowing to invest increases risk, as I've touched on. If your goals can be achieved without taking on this risk, then that's what you should do. Similarly, if your goals mean that, for example, you're going to retire in 3 years' time, then the time frame isn't long enough to be doing a geared strategy too. So always start with the goals and then the strategies flow after that. Okay, well, thanks for listening. If we can help in any way in your wealth creation strategy, book an appointment via the guidance website. Until next time, bye for now.